Hello and welcome. I'm Alex Proimos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. My guest today is Michael Drew. Michael is the Chief Investment Officer at MGD Private. He is also a Professor of Finance at Griffith University. This conversation today will talk about the fundamental underpinnings of a successful investment program from a governance perspective. Specifically, we'll look at understanding the nature of the investment problem, building a sound investment governance framework, the need to understand the mindset of a beneficiary to be a more effective fiduciary. We'll finally then wrap up and talk about the need to build a culture of risk awareness rather than just thinking about risk as being a number on a page. I hope you enjoy the conversation. So Michael, I guess one of the places I wanted to start today was to think about, what are the challenges of being a fiduciary as they sit typically at 30,000 feet. And today we've also got this other added challenge, which is COVID, which has then stopped the ability of people to actually meet physically.
Yeah, great question, Alex. Fiduciaries really at the moment are trying to manage two sides of one coin. There's this important directional governance role that fiduciaries have: compliance, investment policy statements, risk management, risk appetite. So much work being done on ensuring what we would call directional governance is being fulfilled during these stressful days of COVID. But as we've all learned post-Royal Commission, there's another side to that coin, and that's the relational governance. People, culture, making sure that folks do the right thing when we're not watching. So COVID's certainly added to that in terms of how we as fiduciary bodies balance that directional governance with the key importance of relational governance as well.
One of the things that's so challenging today is that typically for a lot of funds, they've gone through a very fast process of actually getting up to speed because it's been such a change with the amount of flow that's come into so many funds. They've had to deal with more things and had to build almost these governance framework on the fly. Is that a pretty fair statement?
Yeah, most funds have got really quite advanced governance processes, but as you correctly said, Alex, they've been under stress. So particularly the prudential standards regarding liquidity cascades, liquidity management have certainly come up the agenda for many fiduciary investors over the last 9 months.
And then you also add the fact that the investment outlook has got even more challenging. We've got cash rates at extremely low levels. Inflation has been low for quite a while, likely to potentially pick up. Discount rates been highly compressed. In this type of environment, you have very high convexity. Small changes are going to have very big impacts on a lot of these asset classes, and particular a lot of these new investment vehicles that are coming up, all these CLOs, for example. So how do you communicate to a fiduciary how to understand so many moving parts?
Yeah, and I think also understanding the nature, a real clarity of understanding the nature of the investment problem is critical in these times. When I started in my career in the early 90s, I could get clients a 7.5% expected return with cash and bonds and zero volatility. Early 2000s, we could get a similar sort of expected return of 7.5% with volatility in the high single digits. Today, to get an expected return of that sort of number, we're looking at 95% growth assets, half of that in alternatives, and a volatility of in the teens. So you're absolutely right. The environment is far more challenging. The outlook is muted. Volatility is here. We having debates again about printing money and maybe the spectre of inflation. All that hasn't quite come to pass yet. So this is really occupying, I would say, 8 minutes out of every 10 of every sort of fiduciary investor's investment governance time.
It is an amazing time when you think about alternatives, right? Alternatives historically was anything outside of debt or equity. Now alternatives is all sorts of other complex instruments and asset classes that are popping up, you sort of wonder for a fiduciary, how do they actually manage all these different parts? There's a lot of moving pieces and a lot of specification that they need to understand around some of these things. They've got to manage that piece, and then they've also got to manage the beneficiaries and explain it to the beneficiaries, which is the other challenge. How do you then map that difficulty of being a good steward and fiduciary and try and hit a target outcome at the same time being able to manage for a beneficiary?
Yeah, my dear co-author Adam Walk and I, when we put together the monograph for the CFA Institute Research Foundation, really wanted to tackle this question head on, and we make the case in the monograph that investment governance needs a budget. It needs to be stated, it needs to be quantified, and when we think about, as large asset owners, investment expenses, that has to be something more than just remunerating investment managers. It has to be, best practice systems, scenario testing, stress testing, liquidity systems. We need great custody and administration arrangements that give us really clean data that we can interrogate in a timely way. And it also needs a resourcing on the monitoring and review piece, that we make sure that we're asking the right questions, interrogating that data and asking the right questions at the right time. And I think to the end of your point about framing that for the beneficiary is just so incredibly important. So understanding our members, understanding their fears at this time, understanding the fact that, there's a mindset of retiring on the Friday with a pot of gold, and the great challenge we have to convert that to a retirement income stream on a Monday, when, say, a 5-year term deposit in the current world might be paying 90 basis points per annum. So there's an incredible human dimension to this, as well as the framing in a way that's understandable of the retirement income liability.
The other thing that keeps coming to mind in terms of actually communicating to members is that we've got this situation where you've got low cash rates and discount rates being low. Just that backdrop means that you've got high convexity. You're going to potentially have very high volatility if there's any change in expectations. So that challenge of then explaining to the beneficiary to stay the course becomes more and more challenging. Okay.
No, it's a great observation. It is, and you framed that really nicely. I'm really a strong supporter of the way we can use behavioural finance to help folks with mental accounting. So really thinking through goals-based investing framework that understands liabilities and their duration, say out to sort of 3, 4 or 5 years, and making sure that we're very clear that that is the priority for that pool of funds to match or meet that liability, and then helping with some mental accounting or grandma's jars and thinking about sort of longer term post-retirement risks, inflation, aged care, a health event. So for me, that kind of framing is really important in the current world, that where we've sort of put aside a part of the corpus for the needs of the next, say, 3 to 5 years, and we can think about a more inflation, CPI plus type objective, and maybe even considering things like, longevity and aged care. How do we make sure that we mortality update and understand that longer term liability as well? As you know, Alex, we've got, PhDs and professors and very smart people, Nobel Prize winners working on these things. But the reality is that in a defined contribution system, the individual household bears much of that risk. So we need to really, as fiduciaries, help those folks understand and frame the sort of long-term risks that are before them.
That's become even more challenging where you've also got the government that's come in and introduced early access, which was, again, another constraint that the funds have to manage for, and as they understand the liquidity requirements that they need, at the same time as trying to manage for this long-term objective that the fund needs to hit. And as a fiduciary, that becomes even more challenging because you're thinking, I've got this target group of 35-year-olds that I need to manage for, and now I've also got these other factors that allow people to withdraw funds. Yeah,
and look, as the weeks and months have gone on, and we've now into the $33, $35 billion mark of early withdrawals, that there's some very serious questions to be asked about how those resources are being used, what's the opportunity cost in terms of fundedness at retirement. And, we all know as humans, we struggle with intertemporal trade-offs. So, we're much more into the gratification than trying to think of our future selves, in 20, 30 years' time. But those numbers will come to roost, that, there really needs to be some really clear thinking going forward about repair of personal balance sheets post-COVID versus how we think clearly about matching that long-term retirement income liability through time.
So if we take it back to the actual, the funds and the fiduciaries as they start with an investment policy statement, an SAA, and then move towards the actual investment decision-making process, how has that had to evolve, would you say, over the last few years, as we've seen the backdrop of asset class expectations change? You've got now more regulation changes, and we're learning more about behavioral finance as well. How are all those factors now moving or at least influencing the decision-making process for fiduciaries?
Yeah, we can be negative about these things, but also I think sometimes we need to just acknowledge the fact that Australia now has, one of the largest pools of retirement saving in the world. Our processes and our institutional quality and governance in our large asset owners, our industry funds, our sovereign wealth funds, really are a globally leading organisation. So I think in terms of part of a good news story is that the pooling that we do, the continued consolidation going on in the industry, is allowing the best minds and a real fiduciary focus on setting up investment portfolios that are there solely to serve the beneficiary. Now, the challenge, as you said, of all of that, is that we are struggling now, next year, maybe the next 5 years, where the key liability hedging asset in retirement, long-term bonds, will either be zero or slightly negative. So we really now are trying to think about what's the right mix of, say, balance sheet-based solutions for our retirees, pooling-based solutions, systematic withdrawal alternatives. So there's a really important piece of work that's coalescing now that really has to face the realities that the key liability hedging asset is marginally above zero. And that ultimately leads to some very difficult trade-offs and difficult conversations about expectations of standards of living going forward.
One particular strategy you didn't address there, I'm curious to get your thoughts on, is around using tail hedging. So continuing on with the higher equity component and using tail hedging as the ability to obviously smooth off those really large down movements that we can see, particularly given the struggle that it is to find returns in traditional fixed income and people have to take more risks. Is tail hedging or more absolute return style long-short strategies going to become more prevalent?
Yeah, and we've written on this, and I've actually written a lot on sequencing risk and path dependency and these sorts of concerns. So you're absolutely right. Non-linear strategies have a role in portfolios and have a different effect at different parts of the life stage. So part of the problem, as you know, for our younger cohorts, 25 and 30, we're probably not getting enough risk into their portfolios. But then in that sort of last decade before retirement, the average Australian accumulates about half of their retirement savings in the last decade of their working life. And so the order of returns during that last decade is actually far more important than the average of returns. So things that we can do to build more robust portfolios that limit equity tail risk, things that we can do that ensure that asset allocation reflects life stage are eminently sensible in terms of how we think through that. And then the one that sort of has really worried me during COVID is the fact that we've had so many people across the economy lose their jobs or be suspended or furloughed, or whatever's been the situation. But we all know the literature and policy research shows us that it's that exact generation that's maybe in the last 10 years of their working life that find the highest levels of discrimination in the workforce. So that to me absolutely keeps me awake at night. And we've also written on things such as inequalities regarding gender and superannuation. Women live a lot longer than men. And again, find these sort of workplace issues come to roost during these sort of retirement years. So that's a long answer to the fact that there's important innovations we need to look at in the asset allocation, but we need to be absolutely aware of labour market dynamics, discrimination in the labour market, and some of the structural discrimination that goes on, particularly around women and super.
Oh, look, there's a lot of issues for fiduciaries to manage, and that the conversation could go on for hours down that path. But if we take it back more to the investment governance process, you mentioned a little bit about it. Funds don't have unlimited resources. They've got fee budgets, they've got time budgets. Let's think about, for a fund that has a governance budget, how do they actually allocate that governance budget given the amount of radical changes that you're seeing in the portfolio today? Members aside and those issues, but just as they think about the investment process and making sure that process is fit for purpose.
Yeah, and look, what we tend to find is that one of the biggest challenges facing all large asset owners today is to make sure that they do see investment governance as a process. It's not just are we doing things right, but are we doing the right things? And that's a very, very different question, to make sure the committee is focused on ensuring not just things are done well, but we are doing the right things. So that leads sort of back to my directional governance and relational governance concerns. The other one that I think is becoming incredibly important is investment principles or investment beliefs and how they align and are evidenced through the portfolio. So when we did the monograph for the CFA Institute Research Foundation, we did some research on looking at actual investment committee agendas, and they'll have in their investment beliefs, we believe asset allocation drives, the largest proportion of returns. Then when we have a look at their actual timing on their investment committee agendas, say 75% of that might be on manager selection. So I think it's important that we constantly challenge the model where we think through what's our objective, does our policy then align to that objective and those beliefs? Do we have clarity about that role setting strategy versus implementation below the fiduciary line? So executing, resourcing, implementing, and we're governing that process without conflict. And then as those returns come up, we superintend the whole process. And we use that superintend word very consciously. It's something more than just monitoring and review, but making sure we're superintending roles, responsibility, and ensuring that the system is governed in a holistic way.
Do you have any views around the use of time and the effectiveness of an SAA style approach versus a total portfolio approach to construction? Is there a governance budget differential? Is it easier to maintain one or the other?
Yeah, they've both got their challenges. And look, the most important thing that we tend to see is not that sort of either or thinking, but sort of both and thinking. So what worries me is when you see an SAA-based framework that doesn't coordinate neatly with the policy, the implementation approach, and the way it's evaluated. So for me, a really important role of a fiduciary on a large asset owner is to actually distinguish between investment expertise and investment governance expertise, and making sure that the delegations, mission clarity, role clarity between those setting strategy and those undertaking the operational work work in harmony and are continually governed.
Mm-hmm. One other area that's popped up quite a bit of late is thematics in the investment idea, because they feel that traditional SAA is just so hard. You can't find the diversification you're looking for, but to invest based on themes, particular themes, whether it's automation or maybe it's something to do with climate or something to do with medicine. What do you think about that, and how do you embed that into an investment decision-making process?
Yeah, so for us, that would start with the investment principles or beliefs, that there would be something formally acknowledged about the role of thematics in portfolio construction. Then we would look inside the investment policy statement to understand how the parameters of that thematic process are governed, controlled, resourced in the portfolio, and then a clear set of instructions and delegations to the chief investment officer and the underlying managers around that thematic process. And of course, as you know, Alex, time horizon is incredibly important with the thematic piece. So are we ensuring that the robustness of the evaluation is not sort of 3 months against peers with a Sharpe ratio, but rather, a time horizon that is sensible and appropriate to the sort of the life of the thematic. And unfortunately, we all see this far too common, that investment committees can get very excited about thematics, but then not put the resources into evaluating that process, different to, say, I don't know, a passive Australian equities manager or something like that.
Mm-hmm. Look, it's a really interesting point, that thematic piece, and actually the corollary then is the role of the CIO, the Chief Investment Officer. Obviously a lot comes from them. I wanted to get your thoughts around the role of the CIO and how that's changed of late, and how you see it being different for different types of funds, family office super fund, sovereign wealth fund. Because just from looking at the industry super funds as one example, there's a huge differential between the CIOs that I see and speak to. Some are from a trading background, some are from a consulting background, others are from a manager allocation background. So I wanted to get your perspective on the role of the CIO and how they should lead a team and obviously a fund effectively.
Yeah, so I think the skills matrix of the fiduciary board, and then obviously the investment committee, making sure that that's done, and really being clear with the skill set that's being leveraged on that governing board, then can really create the space, I believe, for a range of CIOs and professional backgrounds, as you've intimated. That to me is the key thing, that making sure we create the clear delegation, the right space, the certainty around under stress, where the CIO can play, the size of that sandpit, and how they can keep the investment process nimble, focused, responsive, and ensuring that there's the right team around them to support them, challenge them, and of course, like anyone, making sure as best we can to stomp out as much groupthink and blind spots, cognitive blind spots as we can. So there's there's a bit of art and science in that. Certainly in terms of best practice, having a very well-developed skills matrix for the investment committee to make sure that they can appropriately govern the kind of process that's being led through the CIO's office. But what's really, to me, the best CIOs that I have the great pleasure of calling colleagues or working with or governing, to me, have that beneficiary lens on every decision. So they have clear delegation, they're very, very clear on mission clarity, role clarity, and particularly under stress. They, to me, are such a critical gatekeeper of the fidelity with which the organisation has with its beneficiaries. So there's as much a human element to that as there is a technical element to that.
Who do you then see as being responsible for creating a culture of risk awareness, right? The whole idea of the fund is to allocate risk in the best way they can. Should that come from the CIO ultimately, or is there someone else in the fund that should be doing that?
Yeah, for me, it's very clearly from the top, from the trustees. And that sort of becomes that, if you will, signalling to the organisation that we are very, very serious about our directional governance, but we equally weight the relational governance, culture, moral hazard, people, and really, that has to strongly come from the fiduciary body. And then I think where that lands is that then permeates through the organisation in terms of its alignment. And it's important, as you're sort of intimating, Alex, that the CIO is the keeper of that culture across the investment organisation. But to me, the more I've sort of gone through this journey in my own career, the incredibly important role of the chief executive officer, the chief risk officer, making sure that the chief risk officer has a line of sight to, say, the chair of the investment committee and the CEO, has a standing invitation to investment committee meetings, and really creating a culture where risk is an enabler, not a speed bump. And that to me is such an incredibly important piece of work that myself and many others have been involved in the last 9 months, is under stress, a really fantastic, well-resourced chief risk officer function can give a great deal of risk assurance to the fiduciary and ultimately to the benefit of those we serve.
Let's stick on the topic of risk, because risk, unfortunately, a lot of people see it as just a number on a page, a particular point, right? And we've actually got a lot of formulas in finance that work around points. We've got mean variance, got Sharpe ratios, Jensen alphas, so forth, that are all trying to get point values. How do we take risk from just being these point values to being something more?
Great. It's a great question. We've got a whole industry around that framing, so it's important. There's no doubt about that. I mean, my doctorate was actually on that topic, on the performance of Australian super funds and using all of those metrics, Sharpes, Jensens, Gruber, Traynor, information ratios to really do detailed quantitative attribution of skill. And then that works really well to a point. Except what we don't focus enough on in finance courses around the country and around the world is that in many instances, what's actually as important is wealth-weighted returns. So, we kind of teach and frame this stuff. You put $1 in today, you fall asleep for 20 years and you wake up and there's an answer. Now, if there's no cash flow change during the 20 years, the order of returns is completely irrelevant. But the problem we've got is that people get paid fortnightly or monthly, and so there's a cash flow event every few weeks or 12 times a year. And so that creates the real need to have wealth-weighted metrics as part of the governance process. So probability of shortfall, really important. Sequencing risk. So, we know that a sort of, a COVID-like month of March for a 20-year-old, they'll probably have more money in their account at the end of the year just by contributions than a small amount of money being hit by the month of March in COVID. We know someone that's 64 years old retiring in June, that's a very, very different money-weighted impact. So that really is, it's a huge challenge for the industry. It's a huge challenge for regulators. It doesn't fit neatly into a single A4 table sheet of paper, if I could put it that way. We need to think about the life cycle of our beneficiaries, where they are on that life cycle, and how that order of returns impacts the outcome. And this, to me, requires a humbleness of CIOs, of boards, of trustees, that we need to acknowledge that investments are an input to the outcome. They're not the outcome. They might be for time-weighted returns, but ultimately for many beneficiaries, particularly in the sort of organisations we've been speaking about today, superannuation, sovereign wealth funds, family offices, foundations, what actually matters is the wealth-weighted return.
Do you feel that the industry's done enough in terms of the alignment of incentives to make sure that the actual decision makers understand that process?
Yeah, I believe so. And, myself and colleagues sit on a range of, REM committees, and, we're all kept awake at night on ensuring incentives and alignment is correct. But I think the challenge is, to be honest with you, Alex, is that there's this sort of fuzzy area between large industry, large superannuation or large investors, and then bringing that down to sort of the personal balance sheet. So, I'd love to tell you that there was an industry out there full of fantastic, ethical financial advisors. We know that the Hayne Royal Commission has suggested maybe that's not the case. Maybe there is some misadventure. But, the things that have started to warm my heart, particularly over the COVID period, is the rise of fintech, the rise of framing, online sort of framing, helping people nudge into good decisions. So I wouldn't suggest for a minute we've got it sorted, but to me, fintech, robo, these sorts of things are an idea whose time has arrived.
One area that you didn't touch on, which I think is still very problematic, is peer relativeness.
Right.
And so how do you deal, as a fund, as on a personal note, if you're working at some organization, you've got career risk as well. How do you deal with those two issues in terms of the peer of the fund and you personally in making sure that you are managing to, your beneficiary's best outcome at the same time you've got the incentive personally?
I always tell this tongue-in-cheek story where I played first 11 cricket at school. I was the best batsman on the team. I won all the trophies on awards night. We never won a game, and my batting average was 17. The issue of peers and peer relative work are a challenge, not just for this industry, but my schools, my hospitals, my university. And it tends to then boil the debate down to sort of the lowest common denominator, which then really reflects time-weighted returns. Alex, the trustees that I work with and certainly had the pleasure of serving over the years are so deeply concerned about ensuring member outcomes are appropriate for the balance size, their risk appetite, and there's so much work done at a governance level to get those things right. Now, ultimately, the risk is that if we don't temper a peer-based only frame debate, we get the sort of Keynesian problem, and I'll paraphrase it, which is society teaches us at a young age to fail conventionally. So I think we are now at a point in the debate where, with the baby boomers sort of tipping into retirement, the tens of thousands of people moving from sort of either full-time to phased retirement or into full-time retirement, every trustee board around the country is deeply focused on thinking through how can we assist our members in managing these sort of longevity and post-retirement risks. Is the system perfect? No, but there are some very good framing, nudging, behavioural finance tools that can sort of switch out this pot of gold thinking into long-term retirement income stream thinking.
Let's have a wrap-up question, and that is, we've had a huge amount of compliance and regulation that's come in because there has been a few bad actors in the system. How do we take investment governance away from this compliance regulation-driven approach to really being, an organic process that is aligned to members ultimately at the end of the day?
Yeah, and that's really what the whole premise of the book has been, is that the best investors that we've had the privilege of working with in our careers see investment governance as a fortress, that a fortress is only as strong as its weakest link. So great governance bodies never feel the job is quite done. It always feels like there's something more to do. But if fiduciaries leave the meeting feeling that, then that's a much better feeling than the governance document sitting on the shelf and not being opened with the dust sort of blown off until the next Royal Commission comes up. So you're absolutely right. Great governance is an enabler. Studies around the world show that great governance can add 100, 150 basis points per annum to total returns, which in a low return world that we're in is incredibly important. It can stifle and stop misadventure. It can call out quickly the bad actors in the system. And what I think is really important, though, is that, as we've seen with COVID, just the incredible privilege that we're in as fiduciaries in stewarding other people's money. And that, to me, ultimately is the great privilege of the role that many of us are in terms of being a fiduciary, but also represents the call to continue to strive to improve our governance practice.
Mm-hmm. All right, that's been a fantastic conversation. Thank you very much for your time today, Michael.
Thanks, Alex.
Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Connexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.